afternoon, and welcome to our continuing series of webinar events. On behalf of the family office and Abdul Mohsen and all of my colleagues in the Middle East, I'm Bob Castrignano. I'm chairman of the board of the family office, and I'm thrilled to bring one of my closest friends, Anthony Scaramucci, CEO of Skybridge, to our continuing series of discussions on behalf of our clients and prospects in the Middle East. My apologies for starting a little bit late. It was a technical issue on my end. So Anthony, good morning. Welcome.
Good morning, Bob. Good to be here.
And as we have said to our clients over the course of the last couple of weeks and months through the time frame associated with COVID-19, obviously, the markets have been significantly impacted. And in particular, you and I have talked about the credit markets. So given my delay, I thought we'd get right to the point here. I'd love to get your thoughts on both private and structured credit, as well as what you think of the Fed and or Mr. Mnuchin as Secretary of the Treasury's aid in the last couple of months.
Well, let me step back and talk about the stimulus first, and then we'll go down to the structured credit level. But I think that at the end of the day, what the Fed did with Secretary Mnuchin is they took the 2008 playbook, and it turns out that 2008, Bob, was a dress rehearsal for the global pandemic of 2020. And so several things that they did were similar, and there are a few things different. So let's talk about the similarities. The number one thing, take interest rates immediately to zero. The Fed moved mid-March, 150 basis point reduction. Monumental quantitative easing. The Fed pledged $4 trillion of capital with another $2.3 trillion in a facility where they will extend money to banks, which will loan that money to American businesses. And then the banks won't be on the hook for that money. That money's sort of backstopped by the Federal Reserve. So when you step back and look at it, you've got $6.3 trillion of stimulus. I want to compare that to 2008 because I think it's important. In 2008, Dr. Bernanke made a move to create quantitative easing. He deployed $1.5 billion of capital over 18 months. Thus far, the Fed has put about $2.3 trillion of capital into the capital markets in the last 10 and a half, 11 weeks. And so why is that so important? Well, in the book Firefighting, which if you have an interest in reading, I would certainly recommend that book. It was written by Dr. Bernanke, Secretary of Treasury Tim Geithner, and Secretary of Treasury Hank Paulson. The three of them wrote this book in 2018 as a decade after the crisis and a recap of what happened. And one of the most important things in the book was what Dr. Bernanke said. He said, we should have moved faster, and we should have moved with greater monetary stimulus in the financial crisis. And they all circle up related to Lehman Brothers. And while they say it wasn't legal to save Lehman Brothers, they should have figured out a legal way to save it, because Lehman Brothers in that credit seizure cost about 5 unemployment points in terms of U.S. unemployment during the global financial crisis. And so I'm bringing this up as a backdrop because both Secretary Mnuchin and Chairman Powell are talking to the former colleagues. Obviously, Stephen Mnuchin worked for Hank Paulson at Goldman Sachs, but they all have that connectivity now through the Treasury and the Fed. And I'm very, very impressed with what the Fed is doing here as it relates to this global financial crisis. Many of you probably know this, but it's worth repeating. The Fed is extending credit not just to U.S. banks, but international banks. There are banks in Africa, there are banks in Asia that are they're taking more or less junk collateral, giving it to the Fed, and the Fed is flowing back to them U.S. dollars. And so this process is helping the global economy right now. And I think when we look back on this thing 5 or 10 years from now, Bob, people will say, okay, that was very, very good monetary policy from the Fed. 2 minutes on fiscal policy and then structured credit quickly. the 2 minutes on the fiscal policy, the Congress has responded with $2.7 billion of capital thus far. But I think it's very, very important for people to know this. $500 billion of that capital is being dropped into an agency-like structure, which is going to be levered 8-to-1. And so you're going to have these COVID-19 recovery bonds, that's what Larry Kudlow was calling them, to be deployed into the marketplace where people can get actual capital from the feds. A vivid example of this would be United Airlines last week announced that they're going to receiving a $4.5 billion loan from the federal government to help them restore their health of their business and get their planes back up and running, et cetera. And so if you take the two pieces, it's 2.7 from the Congress, but the gearing gets it to 6.7, and you've got 6.3 from the feds. That's $13 trillion of stimulus hitting the U.S. economy, which will have a ripple effect into the global economy. If you estimate economic lost output in the United States over the last 3.5 to 4 months, it's approximately $4 trillion. There's some residual damage to the United States and the nation's businesses and the global businesses. Pier 1 Imports out of business, they vacated their stores. Neiman Marcus bankrupt, JCPenney's bankrupt, et cetera. Many of the local shops on the local main streets in small towns have been shut down, and several of them will not be able to reopen. And so that residual permanency, Bob, is something like $1.4 trillion. So stepping back and looking at the macro, you've got $6.4 trillion of lost economic output, and you've got about $13 trillion coming in from the feds to replace that aggregate demand. So that is unbelievably positive. And so that's why people like Mike Wilson are calling for a V-shaped recovery, and you're calling for a full restoration of the American economy over the next 2 quarters. And I think there was surprising data as it related to unemployment in terms of the last, the first week of June unemployment numbers for May. So this is, for all those reasons, we are super positive on structured credit, not just because we own it, but because the fundamentals are there, particularly on the certain high-graded tranches. The mortgage delinquencies, while they're at a high, and they're sort of tracking where they were in 2011, they haven't blown to pieces like what the expectations were. You're not heading for that 20 to 25% unemployment number that we originally thought could happen as a result of the crisis. And I think this is the last piece why we're so dispositively positive on structured credit. If you look at the PPP, Bob, there's about $700 billion deployed in PPP. If you go to treasury.gov, you'll see that 41 million people, 41 million American jobs are tied to the PPP. 17 million of those jobs are currently registered on the unemployment lines. Why is that positive? Well, the minute we start to normalize the economy, the covenants in those loans require those business owners to hire back the same number of people. And so you'll see a positive delta on unemployment, and everybody on this call knows positive deltas on unemployment are very, very good for credit markets, particularly credit markets tied to the consumer. And we all know on this call that structured credit is effectively tied to the consumer. I'm sorry for being so long-winded, but I wanted to break the whole thing down so people can understand where we are and why we can't overreact or panic out of capital markets at this moment.
It's an interesting word you bring up because, as I mentioned earlier, we've had a continuing number of webinars. This past Thursday, Mohammed Al-Arian was kind enough to speak to our customers, many of whom are on the phone now and listening. And one of the things that he said was that people tend to be frozen. So as you look, not only from the lens of COVID-19 and the recent disruption, but going back to the Great Recession, many on the phone, including yourself, the family office, private businesses had to navigate through the Great Recession, through COVID-19. What are some of the tips that you'd give to our clients, many of whom run their own businesses as well, and frankly are looking for any kind of sort of normalized risk return reward in the yielding markets. How do you think about it?
Well, the number one thing is discipline. It's the number one thing. And what we all find in our experiences, my 31st year in the business, as a lot of people know on this call, you trained me, which is why you are now bald and I have a full head of hair, because I burnt the hair off the top of your head. But the point that I'm making is if you're disciplined, you're going to make a ton of money. If you're undisciplined, you're going to get shaken out of the markets at the absolute wrong time. And so one aphorism that I always say to myself every morning is everybody is a long-term investor until they have short-term losses. The minute they have short-term losses, they strike a match, set their hair on fire, they run around in a circle, and they call the family office or other people and say, hey, get me out of whatever we were doing. I've got to get liquid. I've got to be in cash. I want to blah, blah, blah. And it's the absolute wrong thing to do. And so people like you and me and Abdul Molson, we're trained to run towards where the bullets are being fired from. And so when I'm looking at the capital markets, I want to see where the seizures are in the markets. Credit markets are liquid and fluid roughly 85% of the time over the last 100 years. 15% of the time they go into breach. When they go into breach, that's where the opportunity is. That's where the opportunity is to make money. If you're betting that this time is different, that we won't get back to a normalized environment, that we won't get back to a normalized economy, that we won't reopen, and eventually at some point in our lives not wear a mask when talking with each other, that is absolutely the wrong bet. The apocalyptic scenarios that people have professed are just not going to happen, Bob. And so my thing for people is stay disciplined, stay focused, buy into the opportunity, and recognize what I just said. If you're fighting the Federal Reserve, you are going to lose. You can't fight the Fed in an environment like this. Even if you cannot, from a fundamental basis, completely rationalize where the U.S. stock market is right now, I think it's going to be very, very tough with that water wall of liquidity coming into the markets to prevent that market from trading higher. And so for me, I just like telling people, keep it simple, keep it very based on and grounded on three core principles. Number one, long-term discipline. Number two, buy into the opportunity. And number three, look at liquidity flows. If the liquidity spigot is on, you have to be participating in markets.
Okay, so you and I have talked often over the last 3 or 4 years, and now, in my view, it's particularly germane. You alluded to 38 or 39 million people who have been effectively conditioned to apply for unemployment. Some of those businesses will not return when those people do return. So one of the things that I wanted to talk about, because as Larry Kudlow alluded to, COVID-19 bonds, I think the federal government of the United States needs to show up with a federal program. And what you and I have discussed is the concept of a private public infrastructure bank in order to be a platform and hire some of those people back. Tell us what you're thinking about there.
Well, I mean, listen, I mean, I think you had the idea, so I want to give you the credit for it. I mean, I set you up with Stephen Miller back in 2016, who's obviously the domestic policy advisor for President Trump. And when I was on the transition team, President Trump's transition team, we had the idea of creating a private-public partnership and creating an infrastructure bank. One proposal that didn't get into the tax reform was to allow American corporations to repatriate dollars back to the United States, put them in the bank. They'd have to leave them there for 10 or so years. They'd get a tax benefit for doing that. And then you could take that equity and gear it 5-to-1, 8-to-1, something like that, similar to what the agencies do like Fannie and Freddie. And then you could have a central banking chair figure out how to score infrastructure. One of the biggest problems in the United States in terms of deploying capital into infrastructure is that it seemingly looks like it's going into infrastructure, Bob, and then it ends up somewhere else. And let me give this example from the last crisis. The Obama administration deployed about $900 billion of capital in the form of stimulus. And they block granted it to the states. And so what happened was the states were running budget deficits related to the crisis, and they were going to pave roads. And so what they did was they said, okay, well, we're going to pave those roads anyway. Let's use that money that we just got from the government to balance our budgets. And so you need a real scoring situation on infrastructure. If the roads were already going to be paved by the state and local governments, you're giving them money not to have them, quote unquote, paid for by the federal government, those very same roads that the state was obligated to rebuild. And so therefore you have to have a plus scoring system. And if you had a public versus, a public-private partnership infrastructure bank, you could deploy that capital across the United States, fix the bridges, roads, and tunnels, potentially rebuild a lot of the schools that are crumbling, and you could do it without the taxpayer. You could do it in the public domain, if you will, or the private market, and you could create all of that positive externality, but you have to make sure that you score the infrastructure. Without scoring, what typically happens is politicians find a way to have that money go into places that may not be where you want it to go, to create what you and I know as the positive economic externalities of infrastructure. I want to just lay out for people how important it is. When I left Boston, I graduated from Harvard Law School in 1989. They were embarking upon something known as the Big Dig. They were going to submerge Interstate 93 below the city. They were going to open up a tunnel to the airport, which would make it a 7-minute ride from downtown to get to Logan International. And they were going to create all of this new real estate in downtown because the main central interstate artery was going to be submerged. The estimated cost was $3 billion US. Time of completion was 5 years. It took 15 years to build it, Bob, and $20 billion. The cost overruns were absolutely legendary. And it was rife with corruption and all kinds of nonsense that went on. But when the project was built and done, it created mega positive externalities for the city of Boston. 7 or 8 suburban communities grew around that city because people had more reach. They could go further out into suburbia because the commutation times were cut down as a result of the infrastructure. More technology firms entered the market around the I-95 corridor of Boston. And lo and behold, 10 years after the completion of the project, the $20 billion of infrastructure deployed into Boston has created about $160 billion of positive externalities. So even though it was over budget, it took 10 years longer than it should have to build it. It had this massive transformation to real income, real unemployment, and people's quality of life. And so we are desperate for the infrastructure. If we could figure out a way to cut the nonsense out in Washington and get these people more focused on long-term planning, this would have a great effect on the economy and a great effect on real income and wages for middle and lower middle income people.
Look, I agree. We've talked about that. I want to take a moment now to switch gears because I know that you're no stranger to the region and to the Middle East. You were there in September and you were with Yasser Al-Rumayyan at Vision 2030. And Abdul Masen and yourself obviously hosted the SALT Abu Dhabi conference. So one of the things that's of interest to me, and I think would be interesting to our audience, is the same transformation is going on now in Saudi Arabia. And there is an opening up of tourism. And I mentioned on one of my last broadcasts that I gave kudos to the private equity fund in Saudi Arabia, who at the Nadir had bought Carnival Cruise Lines and had bought Live Nation. So I'd just like to sort of revisit a little bit about SALT and Skybridge throughout the Middle East and change lanes here a bit.
Well, I mean, first of all, I want to thank the family office and Abdul Mohsen for putting on the conference with us. I mean, we had a fantastic experience there, and our relationships in the Middle East were bolstered by the family office. And so we're eternally grateful to that team. But I think the reason why we wanted to be present in the region is that when you step back and look at the macroeconomics of planet Earth, the region is poised for growth. And the region is poised, frankly, for a transition away from the great natural resources in the region into the great intellectual resources of the region. And so what you're seeing right now is sort of this inflection point where we're heading towards greater capital deployment for intellectual capital, services, technology, venture capital. And so for me, I wanted to make sure that we had a conference there and a presence there as we go through that transition. And so, listen, you know the region better than me, but my experience is I love coming to the Middle East. I love coming to Bahrain and Saudi and Abu Dhabi because of the culture of hospitality and the culture of partnership. I think is a fabulous thing for everybody. The concerns I have are always the geopolitical concerns, and the concerns that I have are a lot of people, unfortunately, are welded to the past and welded to things that go on politically that we have still not yet found perfect solutions for. I think you may know this, but I was in Bahrain last year at this time at the Peace and Prosperity Conference that was a coordination between the U.S. administration, the Bahraini government, and others, trying to see if they could come up with they were announcing economic proposals at that time, as opposed to political proposals for the issues related to the Palestinians and the Israelis. It didn't go anywhere, as everybody knows. It's a year later, nothing has basically happened. But I think that the point is we all have to sit down together at this moment in history and figure out if we can, even if we cannot reconcile the past and we cannot reconcile all the grievances of the past, is there a way to go forward? We have the same problem in the United States right now as it relates to the racial tensions. And so I don't know the answer to that, Bob, but if there is a positive answer to that, I would like Skybridge, I would like the SALT conference, I would like myself, you, and others to personally somehow be involved with that positivity. And so for me, I think about a Middle East where some of the resentments are put down, some of the old tribal disputes are put down, and if there's slightly greater harmony, there will be an unleashing of enormous prosperity. And I can't think of a better place to see that happen, frankly. And we all know that all roads in our world, all roads in our civilization lead back to the region. So if the region is healing, it means great promise for the rest of the world.
I agree. So let's bring it a little bit closer back to home now on Skybridge itself. You've been involved. The primary way that you deployed the money was through the credit markets. And like all other firms, there have been some shining sort of silver linings and some more difficult times. As you look forward now to that business model, how much of your future depends on changing the conference and or growing the underlying community of hedge funds? Talk to me a little bit about that.
I mean, our conference business is it started out as a fun project. You remember back in 2009, people were going to Las Vegas. Everyone was concerned who had TARP money from the government. All of the big commercial banks had started canceling their conferences. And so we were a smaller company than we are now back in 2009. We decided that we were going to enter that space and enter the conference space. And so it was 11 years later, that's grown into a very significant business. I could see us having a conference in the Middle East, one in China, and one somewhere in North America and possibly Europe as we start to normalize the economy. And I think these are really fun thought leadership conferences. They're profitable for our company. And I think that they offer an opportunity for people to do three things. They can establish new friends and new relationships. They can learn something. Hopefully we're bringing enough expertise in editorial content where people walk out of these conferences saying, wow, I didn't know that. I'm glad I went to the conference. And then the third thing, which is super important for me, is that people have fun. You know, when I met with the Abu Dhabi Global Markets people to talk about bringing the SALT conference to Abu Dhabi, I said, yeah, we'll have the content. Yeah, we'll have great networking, but I don't want to do this if we're not having a good time. So we figured out a way to create a entertainment module as well, because what I've always found in my life, when people are having a little bit of fun, they relax, their inhibitions come down a little bit, and then all of a sudden they can start forging real relationships. So that's the conference business. As it relates to Skybridge, we were embarking upon launching 3 or 4 new products. And unfortunately, we've had to delay those products. And one was actually a closed-end fund that was going to offer a yield-based product in the United States predominantly. And then we were going to launch a series of sector-specific hedge fund sleeves. Unfortunately, we've had to delay that stuff. And so our flagship product, mostly in structured credit, got hit in the month of March. I think we were down about 24%, where if you're in structured credit, you know that's not so bad on a relative basis. Some guys were down between 40 and 70%. The Angelo Gordon REIT went to 0. I'm not proud of the performance. I'm not saying that it was good performance by any means, but it does present a tremendous opportunity. If you believe what I believe, that the fundamentals are there, that the default rates on mortgages in the United States and residential real estate and all that sort of stuff is not going to happen to the level that people thought originally when the panic started. Well, there's tremendous residual value there. And we're starting to see that percolate in our portfolio now, which thus far this quarter is up about 7.5%. So we're having a pretty strong recovery for structured credit. In 2009, Bob, you remember this, Skybridge suffered a 19.5% loss in 2008. I told people to stay patient. I told them not to sell good fundamentals. Unfortunately, the people that listened, they experienced a 60% return in Skybridge over the following 3 years. So I think we're set up like that again. So I'm pretty optimistic that our flagship product is going to start growing again by the back half of the year, and we can start to initialize the calendar again to create these new products. So, you know, I want to double the business. I mean, I'm very, very excited about where we all are. It's unfortunate that we have a healthcare scare, a financial crisis, which is being abated by the Fed, but there's still a financial crisis, and an oil shock going on at the same time. If you look at the last 120 years of market volatility and disruption and crisis, we haven't had all 3 of those things at the same time except for now. And so this sort of trifecta is disturbing to a lot of people. It's certainly painful in the region when oil is going into full contango and you're actually paying people to accept delivery of oil as we were a few months ago. But the prices are firming now. The economy is going to restart. And I predict that sometime in the middle of 2021, we'll be back to the fourth quarter of 2019 GDP print. And when that happens and people are scratching their heads and saying, okay, what was I doing in the middle of the crisis? Well, I hope and pray that you were not panicking in the middle of the crisis. You had a very sober hand on the wheel and you were looking for opportunity, and you were taking advantage of that opportunity for yourself, your family, your institution, your corporation, because this is not a time to be panicking, especially when you have a global central banking coordination and policy response to what's going on in the capital markets and in the global health of the global citizens.
So let's talk about global macro now, because one of the things that was already ongoing and then was exacerbated by COVID-19, in my view, and I've spoken to both you and Abdul Mohsen about this, is a rethinking of global supply chains and the opportunities and or the beauty marks and warts of how they will change going forward. I know you and I have talked about it. What are your thoughts there?
Well, I mean, listen, I mean, we are fighting it out a little bit geopolitically. There's pressure on each other in terms of where the trade deficits are and where manufacturing is. You can't have state television. I think that was a mistake by state television in China to suggest that they may cut off pharmaceuticals that are needed by the United States healthcare system that are manufactured in China from re-entering the United States. I don't think that that was a great idea, any more than I think it's a great idea for President Trump to be saber rattling on Twitter related to the trade experience with China. And so, but we're in that sort of reality-based world right now where there's a tremendous amount of tension and people are trying to figure out where their manufacturing and industrial policies will be over the next 5 to 10 years. Here's the thing I can tell you. I am hoping that political leadership in the United States, that cooler and more rational heads prevail. I'm hoping that we can sit down and figure out that whether we like it or not, whatever our political differences are, our system differences, our religious differences with China, we are in a bilateral hookup with China. And it is a very strong codependent relationship on each other. And it would be an absolute tragedy for the world if we fracture that relationship entirely. So my prediction is yes, there will be supply chain disruptions. There will be manufacturing moved from China or other parts of the world, and some of it will return even back to the United States, perhaps some of the pharmaceutical manufacturing. And that, if you really study it, it slows down the planet's opportunity and the growth on the planet. David Ricardo, sort of thought of as the father of global trade, had one of the best lines ever, where he said, no nation can produce the goods and services that it needs at the lowest price. And so we have to be very, very careful if you get nationalistic political leadership in large-scale economies where those nations' political leaders want to start to do that. Because if you start walling off nations, literally, figuratively, or metaphorically from each other, you'll raise the price of goods and services globally, and you'll put certain parts of the world, if not your own country, in a recession/depression. So yes, there's pressure there. You see it, I see it. But what I'm hoping is that market forces and good leadership will alleviate as much of that pressure as possible.
Okay, so one of the things, again, changing lanes a bit, that you and I have talked about, and that certainly Abdul Mohsen has been at the forefront of at our firm at TFO, is the process of digitalizing all of the data and sort of fast forwarding in financial services into a new realm where the data that you allude to is maybe even more important sometimes than the product opportunity set. So I know you're doing it at Skybridge. I know we've begun to roll it out to our clients. But from a perspective of what you see over the next 3 to 5 years in digitalization, tell me a little bit about the folks that you've been speaking with.
Well, I mean, listen, it's happening, Bob. We have to make sure that we continue that movement for digitalization, and we have to make sure that we have to, the things that you and I would be concerned about are privacy issues for clients, and making sure as we digitize things, we can't have people hacking into that information and stealing that information. But I think it's happening, and I think it is by and large a good thing. People say, that this phone, this dark or black mirror is causing us problems. We're staring at it too much. But I would actually argue the opposite. I would say that the process of this connectivity it's almost like a human organism is forming where our collective thought and our collective opportunity to learn from each other is going up exponentially. So for me, I accept the digitization, and I think if we just have to consistently come up with the right protocols of privacy and the right protocols of protection, but digitizing everything, in my opinion, is going to unleash exponential growth an exponential opportunity in financial services, in biotech, in healthcare. My son, who my 27-year-old son just graduated from Stanford Business School. About 4 years ago, he called me. He said, "Okay, Dad, our money, our family office, we're going to make this investment." I'm like, "What is that? What's the investment you want to make?" He bought into a software company that is now attached to all of the Anheuser-Busch trucks. And so now this mechanism with the radio frequency inventory, the RFID modules, they can take the truck out on its route, and they can figure out a way for that truck to move through the route that allows for greater efficiency in terms of inventory deployment and a 30% reduction in the energy that the truck is using to drive the route, meaning it's going in certain ways, avoiding traffic, etc. All of this is born from what we're calling effectively digitization. And so I see that. I'm very optimistic about it.
Okay. So I
apologize for that bell ringing. In order to restart this thing, my assistant logged into her email. I'm afraid to touch the computer. I'm afraid, I'm talking about digitization. You and I are like Luddites. I could blow the computer up and then we lose the conversation. But I apologize for the bell, but that's my assistant's email coming into my computer right now.
And I'm the chief Luddite. But in the last 10 minutes here, because I do think we've shared, again, with Abdul and given our experience at Goldman Sachs over 30 years, a lot of time and a lot of effort on behalf of young people. Many of our clients on the phone now are beginning to think through succession, beginning to think through adding, their sons and daughters to their businesses. So I'd love to pick your brain a little bit and think about some tips from your career for young people on the phone now, or those who will be listening in the aftermath.
Well, it's hard for young people. You and I remember being young, and I remember the anxiousness and the self-consciousness related to failure. And I remember, the pressure I had on myself to have a certain social status with my friends in terms of what I was doing and what jobs I was taking. Abdul Mohsen gave me the opportunity to speak to a group of young people last year in Zurich. And I told a story where when I was coming out of law school, I had a combination of social anxiety and where was I going to be positioned, and foolishly, and you know this story, Bob, but foolishly, I wanted what I thought was the coolest job. Not necessarily the job I would be good at, not necessarily the job that I would actually like, but I was, okay, what would my peer group think is the coolest job? Maybe that's working for a big technology company today. For younger people, I don't know. But at that time, it was working for an investment bank or like Goldman Sachs, or a consulting company like McKinsey. This is 31 years ago. And so it just happened to be that the real estate markets were hot at that time. Goldman was very, quote unquote, hot at that time. And maybe it still is today. And so I wanted to be a real estate investment banker at Goldman Sachs. And so I fought like hell to get that job. I got the job. But and I wanted to go to that cocktail party at Harvard Law School and tell my friends that I got the coolest job. The problem with that was I stunk at that job, as you know, Bob, and I ended up getting fired from that job 18 months into it. It was absolutely brutal. It was humiliating. So people think my first firing was from the White House. It was not. Okay, I'm certain I'll end up getting fired again at some point. But what I would tell younger people is I got started at Goldman on August 14th, 1989. I got fired from Goldman on February 1st, 1991. It was absolutely brutal. And then what happened was I went and got another job. Hey, Mayor, I think it's either your sister or something.
Yeah.
Your niece is in the shop behind you. She's a lot better looking. She's a lot better looking than you, Castrignano, by like a quantum. She's now trying to hide behind the chair.
Yeah, true.
She's doing a good job of that. But anyway, to finish up this story, there I am, fired. I'm out looking for a job. And then one of my colleagues calls me and says, well, there might be a job in the sales area up at Goldman, and that's where you and I met. And so I got fired from Goldman, and then I got rehired into Goldman about a month later. Actually, no, I was fired February 1st. I was hired March 28th, so almost 2 months later. And I like telling younger people that story because it's filled with all that trepidation, but there's a lesson there. Go do the things that you like. Go do the things that you think are good for you, that you'll enjoy doing, and then you'll never have to work a day in your life. If you're chasing somebody else's dream or somebody else's impression of what the right things to do are, you could end up like me in a divot or a pothole 18 months into your career. Next point I would make to young people is take risks. For me, I've always taken risks. I grew up in a blue collar neighborhood in a blue collar Italian American family where my dad was a crane operator and an hourly worker for 42 years. And I took a lot of risks in my career. Some things have worked out, and some things like the White House have not worked out. But it's a life well lived if you're willing to take the risks and you're willing to pick yourself up after failures, whatever those failures may be. The last important point for young people, if something goes wrong or you do something stupid, forgive yourself. I don't wake up in the morning and kick myself in the pants for the mistakes I made in the White House that caused my firing. I don't do that. Because life it is what it is. And I also went on to have build a great relationship with General Kelly. And as you know, he has spoken at 2 of our SLAW conferences. I brought him to the region in Abu Dhabi last year, and the 2 of us had a very funny conversation about what we were doing on Father's Day. And the answer was neither one of us was being pampered. We were having a lot of fun with that conversation. So the person that fired me from the White House, which was arguably one of the more rough events in my life, that person has become a very dear friend. And so keep your mind open. Don't take things personally. And if you're on this call and you have access to internet and you have access to the family office, you're living a great life. You've already won the lottery of life. However unfair you think life is, well, guess what? You're on the right side of it. You've already won the lottery of life, and see it from that perspective and try to do the best you can to enjoy yourself. Those are my resonating messages for people.
So
and try to keep your hair if you're a guy out there, okay? Try to keep your hair, okay?
So one last question / comment. You'd made a comment to me 2 weeks ago on the phone, quoting Einstein, and it wasn't a nuance. You said that Einstein once said, "Try not to be a successful person, rather be a person of value." What do you think he meant by that, and why was it important to you?
Well, I mean, he said so many brilliant things, obviously, but I think what he meant there was, there's an equation related to value that may be different from success. I could be a successful surgeon or a successful physicist or a successful money manager, but there's these existential things that are super important in our society in terms of that are quite valuable. So one of those things is mentoring. One of those things is figuring out a way to give back, and a lot of times it's an anonymous give back. One of those things is paying it forward. It could be as simple as watching somebody wipe down and sanitize shopping carts at the local supermarket. They're 20 years old and they've got the hazmat outfit on, and you slip them a $20 bill to let them know that you're grateful that they're out there doing that for everybody. I think Einstein's point was that value is a interesting currency. It comes from your spirit, it comes from your love of life and your love of people. And so ultimately, if you remember the letter that Einstein wrote to Franklin Roosevelt, describing the technology and the power of the atom and what could be unleashed, and how if the rogue sovereign government of Germany at that time had gotten hold of that technology, how damaging that could have been to the world. Value is having the courage to leave that country and come to a place like the United States to share that science and share that knowledge. Now, listen, we're all far from perfect. one of the things that I don't like about our current society is the sanctimony. We're going to go back through history now, and we're going to sanctimoniously judge the people that lived prior to us, that had a different cultural skill set, a different value skill set. We're way less connected than we all are today. This connection that we all have globally should make us realize how close we are and how much our humanity ties us together. And so my point, I don't like the sanctimony going on right now because I think it's damaging. We shouldn't be relitigating the past, and we shouldn't be battling it out in the past. We should be fighting for and winning the future. And that progress means more inclusion for people, more diversity, more opportunity, figuring out ways through good policy to create equal opportunity, always for allowing through good market forces and industry and entrepreneurship unequal outcomes. But certainly people should have, to the extent we're capable, of creating a platform of equal opportunity so that no matter where you were born or who you were born to, you got a chance at life to aspire to the individual that he or she, the individual that you want to be. And so I think those are the things that Einstein meant. It's probably more long-winded than you wanted, but I think those are the things that Einstein meant in terms of the composition of value. It's a very human idea, Bob.
Thank you. Well, look, we're, as I said a moment ago, now up on our time. I wanted to take a moment on behalf of the firm, Abdul Nasser himself, to thank you for your time. Secondly, I'd like to talk to all of our clients and prospects out there. My apologies for the technology kerfuffle here at the beginning. I hope that you continue to tune in. We will be having other webinars in the future. This obviously will be out archived on Bright Talk post our discussion today. So we look forward to seeing you. Yes.
I'm just letting you know I'm calling my agent, okay, because I didn't get the hair, makeup, and lighting that I was promised, okay? So I'm just letting everybody know, okay? The fact that you look slightly better lit than me is bothering me right now. I just wanted to let that out there before we end this thing.
Okay, so you can see from our discussion, Anthony and I go back a long time. We have lots of fun together. That's a prerequisite for doing this. And on a serious note, we hope you continue to get benefit from these webinars, and stay safe, stay well, and we look forward to seeing you in person very soon. Anthony, all the best.
Big honor to be here, Bob. Thank you. God bless.
All right. Bye-bye.
Thank you.